Something just changed in the silver market, and almost nobody is explaining it clearly. Screens that were supposed to turn red are suddenly glowing green. Vault inventories are quietly shrinking, while demand for real metal keeps rising. Institutions that expected prices to fall are now racing to adjust positions they cannot easily exit. And if even a small number of buyers ask for delivery, the system could be forced to reveal what is actually available and what is only a paper promise. Stay with this until the end, because what happens next could decide whether silver is entering a normal rally or the kind of shift markets only see once in decades. Welcome to Market Metal, a place where we slow things down and make sense of the signals that matter, especially for viewers who value experience over noise. If this kind of calm, fact-based breakdown helps you stay prepared, consider subscribing so these updates reach you first. And tell us in the comments, which city or country are you watching from today? The price event that broke the expected model. At that moment, as trading screens refreshed across major financial centers, silver was no longer behaving the way most institutions had expected. The price was holding firm near the $82 level per ounce, a number that only months earlier had been treated as unrealistic by many analysts. For years, the market had been used to silver moving inside controlled ranges, rising and falling in predictable cycles. But now the behavior of the metal was different. The move was not sudden noise, it was persistent, steady, and supported by forces that did not fade after a few trading sessions. Traders who had positioned for a retreat were now watching a market that refused to cooperate with their models. Across New York, London, and Asia, trading desks noticed the same pattern. Instead of the expected pullback, buyers continued to step in whenever the price dipped. The screens that many had expected to turn red were showing long stretches of green. This was not the usual speculative spike that appears during a short burst of enthusiasm. Volume remained elevated, but the price did not collapse under pressure. That combination forced market participants to ask a simple but uncomfortable question. What had changed underneath the surface? For years, large financial institutions had relied on the futures market to manage volatility in precious metals. They used short positions to balance demand and to keep prices from moving too quickly in either direction. This mechanism was not unusual. In most commodity markets, producers, banks, and industrial users take opposite positions to stabilize pricing. The system works well as long as physical supply is available when needed. However, when the price began to rise above previous resistance levels, the cost of maintaining those short positions increased sharply. Positions that were comfortable at lower prices suddenly required much more capital to hold. As silver approached the $82 level, the pressure on those positions became more visible. The higher the price moved, the more expensive it became for institutions to keep betting against it. Margin requirements demanded additional cash. Risk managers started to reduce exposure. Some traders began closing positions, not because they believed the price would fall, but because holding those positions had become too costly. This created a feedback loop. When short positions were closed, buying pressure increased, which pushed the price higher, which then forced more short covering. At the same time, another signal was quietly developing in the background. Inventory reports from major exchanges showed that the amount of silver available for immediate delivery was not growing. In some locations, it was slowly declining. The distinction between silver that was stored and silver that was actually available for delivery became more important. Market participants understood that not all metal inside a vault could be used to settle contracts. Only the portion classified as ready for delivery could fulfill those obligations. As that pool appeared smaller than expected, confidence in the ability to meet large delivery requests began to weaken. Lease rates for physical silver also began to rise. These rates measure how much it costs to borrow real metal, not paper contracts. When borrowing costs increase, it often means that the metal is becoming harder to find. This did not immediately affect the futures price, but it signaled tightening conditions behind the scenes. Industrial users who depended on silver for manufacturing could not rely on price charts alone. They needed actual bars for production lines. As borrowing became more expensive, some buyers chose to secure supply earlier than usual. That behavior added steady demand that did not disappear after short-term volatility. Another development was the widening difference between regional prices. In some Asian markets, physical silver traded at a premium compared to Western spot prices. This created an incentive for traders who could move metal across regions. If they could purchase silver where it was cheaper and sell where it was more expensive, they could lock in profit. Over time, that process tended to pull physical metal toward the higher-priced market. Even a small premium could trigger consistent flows if it persisted long enough. The result was a gradual shift of available supply away from traditional storage centers. These movements were not dramatic on any single day, but together they formed a pattern. The market was sending multiple signals that physical availability was becoming more important than paper positioning. Analysts who looked only at technical charts saw a breakout above long-standing resistance levels. Analysts who examined supply data noticed declining deliverable inventory. Those who monitored funding costs observed rising lease rates. Each signal alone might not have been decisive, but taken together, they pointed toward the same conclusion. The underlying structure of the silver market was tightening. The significance of the $82 level was therefore not just psychological. It represented a point where several long-standing assumptions began to fail. Many institutional forecasts had expected silver to retreat toward lower ranges after previous rallies. That expectation was based on historical behavior, where increased prices attracted selling from producers or inventory holders. This time, that selling pressure was weaker than expected. Some holders appeared reluctant to release metal at current prices, possibly because they anticipated continued demand. When expected supply does not appear, price models built on past cycles start to lose accuracy. Industrial demand added another layer of stability. Unlike speculative interest, which can disappear quickly, industrial consumption tends to follow production schedules and long-term contracts. Manufacturers that require silver for electronics, energy systems, or specialized components cannot easily pause operations due to short-term price changes. They must secure material to keep production running. This type of demand does not chase momentum, it follows necessity. As long as those sectors continued expanding, a baseline level of buying remained in place. The behavior of hedge funds and systematic trading strategies also began to shift. Many of these participants rely on confirmation signals before entering positions. A sustained move above previous resistance often triggers algorithmic buying. When silver held above earlier thresholds, some of these systems started allocating capital to the sector. This did not happen all at once. It occurred gradually as trend confirmation strengthened. The effect was additional liquidity entering the market on the long side, reinforcing upward pressure. Meanwhile, commercial participants, who typically represent producers and industrial users, showed signs of reducing their net short exposure. This adjustment suggested acceptance of higher price levels as part of the new environment. When commercial traders stop aggressively selling into rallies, the market loses a stabilizing force that previously limited upside movement. Without that counterbalance, price swings can extend further before meeting resistance. The combination of these factors created a situation that differed from previous cycles. Rising prices were not immediately met with overwhelming supply. Short positions became more expensive to maintain. Physical availability showed signs of tightening. Industrial demand remained steady. Systematic capital began to enter. Each element alone might not have changed the market's direction, but together they altered its momentum. Observers who had followed the silver market for decades recognized that such moments were rare. Commodity markets often experience volatility, but structural shifts occur less frequently. When multiple indicators align, price behavior, inventory data, funding costs, and demand trends, it usually signals more than a temporary fluctuation. It suggests that the balance between supply and demand is moving into a different phase. By holding near the $82 level, silver was effectively testing whether the traditional mechanisms that once contained its price were still effective. The answer was not yet final, but early evidence showed increasing strain. Institutions that had relied on predictable cycles were adjusting their strategies. Industrial buyers were securing material earlier. Traders were watching delivery data more closely than usual. In that environment, the price itself became a signal rather than just an outcome. It reflected the cumulative pressure of decisions made by producers, banks, investors, and manufacturers across the globe. The move above previous ranges was not simply a headline event. It was the visible expression of deeper forces that had been building quietly over time. As the market continued to operate under these new conditions, participants understood that the coming delivery cycles would provide further clarity. If physical demand remained strong and available, supply did not expand, the pressure on existing positions could intensify. If additional metal entered the system, some tension might ease. For the moment, however, the $82 level stood as evidence that the expected model had been disrupted and that the silver market was entering a phase where physical realities were beginning to outweigh long-standing financial assumptions. The physical constraint that the market can no longer ignore. While the price movement above $80 captured the attention of trading desks, the deeper story was unfolding far from the screens. It was developing inside mines, refineries, and industrial supply chains where the actual metal had to be sourced, processed, and delivered. Market participants who looked beyond charts began to notice that the issue was not simply rising demand. The more important factor was that supply could not expand fast enough to respond. Silver is often discussed as if it were produced in the same way as gold, but the structure of its supply is very different. In most cases, silver is not mined as the primary target. It is extracted as a byproduct during the production of copper, lead, and zinc. This means that even when the price of silver rises, mining companies cannot immediately increase output. Their main decision is driven by the economics of the primary metal, not silver itself. As a result, higher prices do not lead to a rapid surge in new supply. The system reacts slowly, sometimes taking years before any meaningful increase appears. At the same time, existing mines have been facing declining ore grades. Over decades, the richest deposits were extracted first. What remains often contains lower concentrations of metal, which forces operators to process larger volumes of rock to produce the same amount of silver. This raises operating costs and limits how quickly production can grow. Even with advanced technology, there's a physical limit to how much material can be moved, crushed, and refined within a given time frame. New mine development does not provide a quick solution. From discovery to full production, a typical project can take 7 to 12 years. During that period, companies must complete environmental studies, secure permits, build infrastructure, and raise capital. Any delays, whether regulatory, political, or financial, extend the timeline further. This means that today's price signals will not translate into new supply for many years. The market must rely on existing operations that are already running near capacity. Geography adds another layer of complexity. A large share of global silver production is concentrated in a small number of countries, including Mexico, Peru, China, and a few others. When output depends heavily on limited regions, any disruption, such as labor disputes, regulatory changes, or local instability, can affect global availability. Even temporary interruptions can reduce shipments enough to tighten the market, especially when inventories are already low. While supply growth remains constrained, demand has been expanding across multiple sectors at the same time. Silver is not only a monetary metal, it is also a critical industrial input. It is used in electronics, energy systems, medical devices, and high-performance components that require reliable electrical conductivity. Unlike gold, which is often stored and reused, much of the silver used in industry is consumed in ways that make recovery difficult or uneconomical. Once embedded in small electronic parts or thin coatings, it rarely returns to the supply chain. The energy transition has added a new layer of demand that did not exist at scale in previous decades. Solar panels require silver for conductive pathways. As installations increase worldwide, each new project locks additional metal into long-term use. Electric vehicles, charging infrastructure, and advanced battery systems also rely on silver for key connections and control systems. These applications are tied to regulatory commitments and long-term investment plans, which makes their demand relatively steady even during economic fluctuations. Recycling has not been able to offset this consumption. Although silver can be recovered from certain industrial processes, the quantities per device are often too small to justify the cost. Collecting, separating, and refining used components requires time and expense that exceed the value of the recovered metal. As a result, recycled supply grows slowly and cannot match the pace of new demand. Over several consecutive years, these dynamics have created a persistent deficit. Global consumption has exceeded annual mine production, forcing the market to draw from above-ground inventories that were built during earlier periods of surplus. At first, this drawdown was not alarming because stored metal appeared sufficient. However, as the deficit continued, the buffer began to shrink. The longer the imbalance persists, the more sensitive the system becomes to any additional disruption. Industrial buyers have responded by changing their behavior. Instead of purchasing only when needed, some companies have begun securing material earlier to avoid future shortages. This shift does not create sudden spikes, but it adds a steady layer of demand that remains present even during price volatility. When multiple industries adopt the same cautious approach, the cumulative effect is significant. Refiners and mints have also reported increasing pressure. Orders for physical bars and industrial products have risen at a pace that challenges normal production schedules. Allocation systems, where customers receive only a portion of what they request, have been introduced in certain cases. These measures are typically used when demand temporarily exceeds available output. Their reappearance after years of stable supply suggests that the underlying balance is tightening. Premiums for physical products have widened as well. Buyers willing to pay above the quoted futures price indicate that immediate access to metal is more valuable than waiting for standard delivery channels. This difference between paper pricing and real-world transactions does not always persist, but when it does, it signals that supply chains are under strain. At the same time, the cost structure of mining has been shifting. Energy, labor, and equipment expenses have risen across the resource sector. For primary silver producers, the all-in sustaining cost provides a rough estimate of the price level required to maintain operations. As these costs move higher, the floor under the market price tends to rise as well. Producers are less likely to expand output aggressively unless they can secure long-term profitability. The combination of constrained supply, steady industrial demand, and limited recycling creates a system that cannot quickly adjust. When demand increases even modestly, the effect on price can be amplified because there is no immediate source of additional metal. This is different from commodities where stockpiles are large and production can be scaled rapidly. Investors who study these mechanics recognize that price movements are often the final stage of a longer process. The structural imbalance forms first, sometimes years earlier. Only when inventories fall to critical levels does the market begin to reflect the underlying shortage. By the time the price reacts, many of the supply limitations are already locked in. In this environment, the recent strength in silver is not simply a reaction to sentiment. It is the visible result of physical constraints that have been building quietly across the production chain. Mines cannot expand overnight. Recycling cannot fill the gap. Industrial demand continues on schedules that do not pause for market volatility. As these forces interact, the market enters a phase where each additional ounce becomes more difficult to source than the last. Participants who depend on consistent supply begin to compete for available material. The competition does not always appear in headlines, but it shapes pricing behavior over time. The critical question now is not whether demand exists, but whether supply can respond before inventories tighten further. Until new production arrives, which could take years, the market must operate within the limits of what is already above ground. In such conditions, even small changes in buying patterns can produce outsized effects. This is why the current price environment carries more weight than a typical rally. It reflects a structural constraint that cannot be resolved quickly. The system is adjusting to a reality where physical availability, not just financial positioning, determines outcomes. And as long as that constraint remains in place, the pressure beneath the market continues to build quietly but persistently, shaping the next phase of the silver cycle. The growing tension between paper promises and physical reality. As the supply constraints became clearer, another layer of pressure began to surface, one that did not originate in mines or factories, but inside the structure of the financial system itself. The silver market had long operated on two parallel tracks. One track involved physical metal, bars, coins, and industrial supply moving through vaults and refineries. The other track existed in the world of contracts, futures, swaps, and synthetic exposures that allowed participants to trade price movements without ever touching the metal. For decades, these two systems functioned together without major conflict. Now, the distance between them was starting to widen. The expansion of paper claims had been gradual. Futures contracts, exchange-traded products, and over-the-counter agreements allowed large volumes of silver exposure to exist on balance sheets without requiring immediate delivery. This structure improved liquidity and made price discovery more efficient under normal conditions. Traders could hedge risk, producers could lock in revenue, and manufacturers could plan costs. The system depended on a simple assumption. Only a small percentage of participants would ever request physical settlement at the same time. As long as that assumption held, the ratio between paper claims and available metal did not attract much attention. But as inventories tightened and industrial users grew more cautious, the question of delivery began to matter again. Reports showed that the volume of open contracts represented claims on far more silver than was classified as ready for immediate delivery. This was not unusual in derivatives markets, yet it became significant when confidence in supply started to weaken. If even a modest share of contract holders decided to take delivery instead of rolling their positions forward, the exchange would need to source additional metal quickly. Historically, most contracts were settled financially. Participants closed positions or accepted cash differences rather than requesting bars. This kept the system efficient and avoided logistical challenges. However, the current environment introduced a new motivation. Industrial buyers who required reliable supply found that futures delivery could sometimes be cheaper than purchasing metal in the retail market, where premiums had expanded. By standing for delivery, they could secure material closer to the quoted price. This shift changed the usual behavior pattern and increased the number of delivery notices. At the same time, regional price differences began to influence physical flows. In certain Asian markets, silver traded at a consistent premium to Western spot prices. For traders with access to logistics networks, this created a clear arbitrage opportunity. Buying metal where it was cheaper and selling where it was more expensive generated low-risk profit. Over weeks and months, this process encouraged metal to move toward the higher-priced region. Even if each shipment was modest, the cumulative effect reduced available supply in traditional storage hubs. Export policies also shaped these movements. Some jurisdictions tightened controls on refined silver leaving their borders, effectively turning inbound metal into long-term domestic supply. When metal enters such markets, it does not easily return to the global pool. This one-directional flow acts like a slow drain on Western inventories. It is not dramatic enough to create a sudden shock, but it steadily reduces the buffer that once absorbed fluctuations. Financial institutions attempted to manage the situation using familiar tools. Margin requirements were adjusted to reduce excessive leverage. Contract specifications were reviewed, and smaller-sized futures were introduced to broaden participation. These measures were intended to stabilize trading and distribute risk across more participants. In normal cycles, such adjustments can calm volatility, yet they do not create new metal. When the underlying issue is physical availability, financial engineering can only influence behavior, not supply. Lease rates provided another signal. The cost of borrowing physical silver rose, indicating that holders were less willing to part with their inventory. Higher borrowing costs discourage short sellers because maintaining positions becomes expensive. At the same time, they encourage holders to keep metal rather than lend it into the market. This dynamic reduces circulating supply and reinforces the perception that physical material is becoming scarce. Large trading desks faced a difficult calculation. Reducing short exposure could limit losses if prices continued rising, but closing those positions required buying contracts in a market already under upward pressure. Maintaining the positions demanded additional capital due to higher margins and borrowing costs. Either choice carried risk. This is the type of environment where small decisions, repeated across many institutions, can collectively shift market direction. Confidence plays a quiet but powerful role in such systems. The futures market relies on trust that contracts will be honored with either cash or metal according to established rules. If participants begin to doubt the ease of obtaining physical delivery, their behavior changes. They may demand allocated storage, prefer direct purchases from refiners, or reduce reliance on unallocated accounts. None of these actions cause immediate disruption, but together they reduce the flexibility that once allowed banks to balance supply and demand through internal inventory. Precedents from other commodity markets serve as reminders of how quickly conditions can escalate. In past situations where short squeezes developed, exchanges intervened with rule changes or temporary trading halts to restore order. Such actions protect systemic stability but can also damage confidence if participants feel outcomes are being altered mid-process. The silver market is larger and more globally distributed than many niche commodities. Yet the lesson remains relevant. When physical constraints meet leverage positions, volatility can increase sharply. Global diversification of trading venues has also changed the landscape. Price discovery no longer occurs in a single center. Asian exchanges, Middle Eastern hubs, and regional over-the-counter markets all contribute to the final price. This makes coordinated control more difficult. If one venue experiences stress, activity can shift elsewhere. While this resilience reduces the chance of a complete breakdown, it also means that physical shortages in one region can quickly influence prices worldwide. Institutional investors have started to recognize the distinction between exposure and ownership. Holding a financial product that tracks the price of silver is not the same as possessing allocated metal. This awareness has led some funds to review custodial arrangements and storage practices. Requests for transparency about backing and inventory have increased. These steps do not remove liquidity from the market overnight, but they signal a gradual preference for certainty over convenience. The tension between paper representation and physical reality therefore continues to build in subtle ways. Each rising lease rate, each delivery notice, and each premium in a distant market adds another piece to the same picture. The system still functions, contracts still settle, and trading continues. Yet the margin for error appears smaller than before. From a structural perspective, the situation resembles a balance held in place by confidence. As long as most participants remain comfortable rolling positions forward, the existing ratio of paper claims to physical metal can persist. But if a larger share decides that immediate possession is preferable, the demand for actual bars could exceed what is readily available. Exchanges would then need to locate additional supply, encourage conversions from non-deliverable inventory, or consider alternative settlement methods. None of these outcomes are inevitable, but the possibility alone changes behavior. Risk managers become more cautious. Industrial users extend procurement timelines. Traders monitor inventory reports more closely than price charts. The focus shifts from short-term speculation to logistical certainty. In this phase of the cycle, the silver market is not defined by a single dramatic event. It is shaped by the steady accumulation of small pressures that point in the same direction. The paper market continues to provide liquidity and efficiency, yet its dependence on physical backing is becoming more visible. As the gap between promises and availability narrows, each delivery cycle carries greater significance. What remains uncertain is how the system will adapt if demand for real metal continues to rise. It may find new sources of supply, or participants may adjust expectations and reduce leverage. For now, the tension persists, quiet, measurable, and increasingly central to how the market interprets price. The strategic shift that markets rarely announce in advance. By the time the tension between paper exposure and physical availability becomes visible, the market is usually already in transition. Silver's move into the higher price range was not just a reaction to short-term buying. It began to signal a broader change in how capital, institutions, and governments were starting to view the metal. For decades, silver had been treated primarily as an industrial input with occasional speculative cycles. Now, its role was quietly expanding into something more strategic. Large asset managers and institutional allocators were not reacting to headlines. They were responding to patterns that tend to develop slowly and then accelerate. One of those patterns was the declining correlation between traditional financial assets and certain hard commodities. When equities and bonds move together during periods of monetary uncertainty, investors often search for assets that behave differently. Silver, because of its dual nature as both an industrial material and a store of value, began to re-enter discussions about diversification. The shift did not occur through public announcements. It appeared in portfolio adjustments, research notes, and gradual allocation changes. Funds that previously considered silver too volatile started reassessing its role as a hedge against currency risk and supply chain instability. Even a small percentage shift from large pools of capital can influence markets when the underlying physical supply is limited. The process was slow, but it introduced a new category of demand that was not tied to short-term speculation. At the same time, governments and policy institutions were paying closer attention to critical minerals. Silver's importance in energy systems, advanced electronics, and medical technology placed it in the same conversation as other strategic resources. When a material becomes essential to infrastructure and national security, supply reliability becomes a priority. Discussions about domestic production incentives, strategic reserves, and supply chain resilience began to include silver more frequently. These conversations did not immediately change market prices, but they signaled that the metal's importance was being reclassified at higher decision-making levels. Geopolitical dynamics added further weight. As trade relationships shifted and financial sanctions became more common tools of policy, many nations sought assets that existed outside traditional currency systems. Precious metals have historically filled that role because they do not depend on any single country's financial network. While central banks primarily accumulate gold, increased attention on precious metals in general tends to influence investor behavior across the sector. When sovereign entities focus on hard assets, private capital often follows. Another structural factor was the size of the silver market itself. Compared to major bond or equity markets, the total value of available silver is relatively small. This means that even moderate capital inflows can produce noticeable price effects. Market depth that once seemed sufficient can become thin when multiple large participants attempt to secure exposure at the same time. Liquidity remains present, but it can shift quickly, especially during delivery periods or when new data highlights supply constraints. Institutional strategy also evolved in response to changing risk assessments. After several years of heightened monetary expansion and repeated financial disruptions, many risk committees began emphasizing resilience over maximum yield. Assets that could retain value during currency volatility gained attention. Silver's historical behavior during periods of monetary stress, initial weakness, followed by strong recovery, fit this framework. It was no longer viewed solely as a cyclical commodity, but as part of a broader risk management toolkit. This reclassification had subtle but important consequences. When an asset moves from a speculative interest to strategic allocation, holding periods tend to lengthen. Capital that might once have entered and exited within weeks began staying in place for quarters or years. Reduced turnover can tighten available supply in the trading ecosystem because fewer participants are willing to sell into rallies. The market becomes more sensitive to new demand because existing holders are less responsive to short-term price changes. At the same time, the structure of global trade in physical metals continued to diversify. Hubs in the Middle East and Asia expanded their role in storage, refining, and distribution. This geographic spread reduced reliance on any single financial center for price discovery. While it improved resilience, it also meant that supply imbalances in one region could influence pricing elsewhere more quickly. If metal moved toward regions with persistent premiums, traditional inventory centers could experience tightening conditions even without a dramatic global shortage. Industrial strategy reinforced these trends. Companies dependent on reliable silver supply began evaluating long-term contracts and direct relationships with refiners. Some explored partial vertical integration to secure material flow. These decisions are rarely visible to the public, yet they affect how much metal remains available for open market trading. When end users lock in supply through private agreements, fewer ounces circulate through exchanges where prices are set. The combination of institutional allocation, government awareness, and industrial procurement created a layered demand structure. Unlike a single speculative wave, this type of demand is distributed across multiple sectors with different motivations. Financial investors seek diversification, manufacturers seek continuity, and policymakers seek security. Each group acts independently, but their actions converge on the same limited resource base. From a strategic perspective, such convergence often precedes longer-term repricing phases. Markets tend to adjust gradually at first, then more rapidly once consensus forms. Early participants focus on data and structural trends. Later participants react to price itself as confirmation. By the time widespread attention arrives, much of the foundational shift has already occurred. Risk scenarios also become more complex in this environment. If physical tightness intensifies, delivery cycles may experience higher volatility as participants compete for available inventory. Exchanges may introduce administrative measures to maintain orderly settlement. If additional supply enters through new production or recycling, some pressure could ease temporarily. The outcome depends on the balance between incoming material and persistent demand from industrial and financial sectors. What remains consistent is that structural forces rarely reverse quickly. Mining capacity cannot expand overnight. Industrial applications do not disappear because of short-term price changes. Institutional allocation decisions, once approved, are typically reviewed over long horizons. These characteristics create momentum that extends beyond individual news events. Silver's current position, therefore, reflects more than a single rally. It represents the intersection of constrained supply, diversified demand, and shifting perceptions of risk within the global financial system. The price level near the low 80s is not simply a number on a chart. It is a marker showing where these forces have met so far. Whether the market stabilizes or advances further will depend on how these pressures evolve during upcoming delivery cycles and procurement periods. For decision makers observing from the business and investment community, the key takeaway is not to predict a specific price path, but to recognize the nature of the transition. When an asset moves from being treated as abundant to being treated as strategically important, behavior across the market changes. Participants prioritize access, reliability, and long-term positioning over short-term gains. In that sense, the current phase of the silver market resembles earlier periods in other critical resources, where structural awareness preceded lasting repricing. The signals are not dramatic on their own, inventory trends, allocation shifts, policy discussions, but together they form a coherent picture. It is a picture of a market adjusting to new constraints and new priorities. As this adjustment continues, each quarter brings additional data points that either confirm or challenge the emerging narrative. Delivery statistics, production reports, and procurement patterns will reveal whether the structural imbalance persists. Until those signals change, the market operates under the assumption that physical availability matters more than it did in previous cycles. That assumption, once established, tends to influence decisions long before it appears in mainstream commentary.